Under Armour shares getting a big boost today after an upgrade from the top retail analyst on Wall Street. JPMorgan's Matt Boss raising his rating to overweight. That's after nearly 9 months on the sidelines. He's live with us today from New York. We've made it our call of the day. Matt, it's good to see you again.
Thanks for having me back.
When Matt Boss speaks, people listen. Why the upgrade today?
Look, we were at headquarters on Monday, and I think the tone has changed. The fire seems to be back. You know, really over the last 2 years, they've made some key hires. They brought on Patrick Frisk from VF Corp. But they've rationalized SKUs 50%. They've cut their vendor base by 30%, and they've shortened the lead times by 25%. They're overhauling the marketing heading into next year, and we expect the new product to match the inventory reduction of 24%. And so you see more full price selling with the expense base rationalized. So as you look at the next 2 years, we see a tremendous amount of earnings power. And over the next 5, it translates to a 40% earnings growth on average.
That's been the anvil on this story, has been, heavy inventory, heavy discounting, and then, surrounded with a lot of noise about whether the company had lost its focus or not. And you say all of that at this point has been alleviated.
Look, I think there's a couple factors at play. You have a very strong underlying athletic marketplace. And so you have a $92 billion athletic-focused performer market, of which Under Armour today makes up only roughly 5%. That market is growing at an outpaced run rate versus the rest of retail. And so they're in the right marketplace with inventories clean in the channel. The second piece to me, CEO Plank said at our meeting that this is a company that used to swing for the fences on every pitch, and now they're willing to take that first pitch. And so the discipline is back with the opportunity next year. The exact comment was, we're going to light this brand on fire next year. So it's been a quieter brand as they've made these changes and as they fix the operational backdrop. And I think now they're ready to really show what this brand's made up of, and in the right sector with real growth in that athletic segment.
We're watching the stock tick higher as we speak about it. It's at the highs of the day right now. It's interesting, too, that the headline of your note makes a suggestion, unless I'm reading it wrong. You say athletic is in the sweet spot. So are you saying that what had been a long trend of athleisure, and that hurt Under Armour? They seem to be unprepared for that in terms of a product, that now we're back to focusing on athletic, what's at the core of a Nike or an Under Armour, and they are well primed and positioned to succeed in that arena?
I think it was a combination of macro and micro. So look, when Nike catches a cold, Under Armour is going to catch the flu. And Nike's inventories 2 years ago were not where they were today. I think the second piece is you have an innovation cycle. One of the things that Under Armour talked about at our headquarters visit was having a stacked innovation pipeline for the next 5 years. Layer that on with the marketing turn that we expect to happen next year. And so I think you have the macro and the micro. One of the things that I think happened with Under Armour on the more micro was I think they got outside of their core, meaning, again, talking about swinging for the fences on every pitch, I think that segmentation and I think that backdrop from an operational perspective was part of what had been missing. And I think now as they look to grow, what they talked about was the shrink phase is now behind us. Inventories came out of last quarter down 24% year over year. So the shrink is behind us, and now they're ready to regrow off of the right base, and that's technical innovation rather than fashion.
I believe everything you say, and I believe that Kevin Plank convinced you, and that what he says is true. At the end of the day, I'm still left with a company that's at 57 times forward this year's earnings. That's a ridiculous multiple. I've got Nike that is, maybe it's not going to grow as fast because it didn't screw up as much in the past, but Nike is lower valued. I've got Lulu, it's got a lower valuation. So why would I want to buy this? Seems like most of the good news is not only in it, but more good news than is in it is expected. I just don't get the valuation here.
So I think you need to take a step back. The earnings base that you're talking about is 27 cents exiting 2018. You have a company at a 4.5% margin versus Nike in the mid-teens. I think the reality is that's the opportunity, meaning you clean up the excess distribution. This company in the last 2 years has had flat revenues in North America, while arguably taking 30% in terms of the lead times. and rationalizing SKUs by 50% while cutting product out of the off-price channel, and they still managed to keep the revenues in the North American channel flat over that time. So I think the answer is you have a depressed earnings base, you have a depressed EBITDA base, and the question is more the forward opportunity. And as they've laid out, 5 years from now, that's the opportunity to get this brand back to a 10% margin that's growing in the high single digits.
Okay, Matt, so let's look at then your price target and your estimate of 56 cents. So that's 41 times earnings. How many companies of this ilk have sold at 41 times earnings on a forward basis?
So we're looking for a one peg to the 40% earnings growth that we see over the next 5 years.
But that's not normalized.
On our 21 numbers. That's actually 5 years straight of 40% earnings growth, and that's the opportunity to get this to a 10% margin. If you look laterally, Ralph, Coach, Nike, and Lulu all saw 200 basis points of gross margin expansion in the next 12 months following that inventory cleanup. That's not in street estimates. So I think you actually have upside to the E that the street is using and to our model, frankly, combined with, from a valuation perspective, I mean, I'm using, frankly, the 3-year average EBITDA multiple on our numbers 2 years out to get to a $29 price target. If I use the 5-year average, which I would actually make the argument is more representative because 2 of the last 3 years have actually been during this shrink period of the shrink to grow, I'd actually come up with a mid-30s valuation, and that's 50% upside from today's price.